Hello friends and welcome to another class on bank promotion study. In this class, we are going to learn about monetary policy and interest rates. What is monetary policy? Monetary policy refers to the policy of the central bank, that is Reserve Bank of India, with regard to the use of monetary instruments under its control to achieve the goal specified in the Act. The primary objective of the RBI's monetary policy is to maintain price stability while keeping in mind the objective of the growth. What is the Monetary Policy Committee? Under the Section 45ZB of the amended RBI Act 1934, the central government is empowered to constitute a 6-member Monetary Policy Committee. The Section 45ZB lays down that the Monetary Policy Committee shall determine the policy rate required to achieve the inflation target. The decision of the Monetary Committee shall be binding on the banks. Composition of Monetary Policy Committee. Monetary Policy Committee shall consist of 6 members: RBI Governor as ex officio chairperson, Deputy Governor in charge of the monetary policy, an officer of the bank to be nominated by the Central Board, 3 persons to be appointed by the central government. This category of appointments must be from persons of ability, integrity and standing, having knowledge and experience in the field of economics or banking or finance or monetary policy. The monetary and credit policy statement of RBI is issued bi-monthly, that is once in every 2 months. Interest rates. RBI has deregulated interest rate on domestic term deposit, domestic saving deposits of banks, NRE and NRO. The interest rates on mentioned deposits are decided by the Board of Directors of the bank. Board of Directors may delegate the power to Asset Liability Management Committee of the bank to decide interest rates on mentioned deposits. So sometimes ALCO, Asset Liability Management Committee, is known as ALCO also. However, for interest rates on FCNRB, ceiling on interest rates, RBI has deregulated interest rates on domestic term deposit, domestic saving bank deposits of banks, NRE and NRO. The interest rates on mentioned deposits are decided by the Board of Directors of the bank. Board of Directors may delegate the power to Asset Liability Management Committee of the bank to decide interest rates on the mentioned deposits. However, for interest rates on FCNRB, ceiling on interest rates has been prescribed by RBI. So for FCNRB, the ceiling on the interest rates are prescribed by RBI. There is no payment of interest on deposits in current accounts. For advances, RBI has deregulated interest rates except DRI, differential rate of interest advances, where the rate of interest is 4% per annum. All floating rate loans except which are exempted shall be priced with reference to benchmark. When the floating rate advances are linked to an internal benchmark rate, banks shall determine their actual lending rates by adding the components of spread to the internal benchmark rate. MCLR. MCLR stands for Marginal Cost of Funds Method for interest rate on advances. MCLR full form is Marginal Cost of Funds Based Lending Rate. The Reserve Bank of India gives a fixed internal reference rate for banks under it. The interest rate is used by all banks and non-banking institutions as their minimum interest rate applicable for lending any loan. It has replaced the earlier base rate system which was introduced in the year 2010 for determining lending rates for commercial banks. What is MCLR? It is the lowest rate of fund lending. No bank is permitted to lend below MCLR. The methods used to renew credit limits and sanction loans are as per MCLR norms. It is determined by the banks internally depending upon the loan repayment time. Review of MCLR. Banks shall review and publish their marginal cost of fund-based lending rate (MCLR) of different maturities every month on a pre-announced date with the approval of the board or any other committee to which the powers have been delegated. Reset of interest rates under MCLR. The periodicity of reset shall be 1 year or lower. MCLR prevailing on the day of the loan is sanctioned will be applicable till the next reset date. MCLR rate varies from one bank to another. Banks shall publish MCLR for the mentioned frequencies on their websites. The overnight MCLR, 1 month MCLR, 3 months MCLR, 6 months MCLR, 1 year MCLR. Besides above mentioned, banks have the option of publishing MCLR of any other longer maturity. Generally, banks publish 2-year MCLR and 3-year MCLR in addition to the above mentioned frequencies. What is the purpose of MCLR? Under MCLR, as soon as the repo rate changes, banks must adjust their interest rates. MCLR is implemented to bring transparency and uniformity at the interest rate on advances followed by banks. It is also calculated that the interest rate is equally fair and beneficial for banks and the borrowers. As a result, banks will improve their long-run value and become more competitive using marginal cost pricing of loans. Calculation of MCLR. For calculating MCLR, all the sources where a bank borrows its funds from should be considered. This is called the marginal cost of funds. These include FD, current account, SB accounts, and equity or the retained earnings. The rate of interest used in these sources gives us marginal borrowing cost of the bank. What factors impact MCLR? Bank must maintain a cash reserve ratio of 4%. Banks can avail some allowance under MCLR. It is called negative carry on MCLR. It happens when the CRR balance is zero, that is when the actual return is lesser than the cost of funds. The operating cost related to providing loan products must be considered. There are other various expenses of a bank that are separately charged from the customers but are not part of calculation of MCLR. They include fundraising, salary payment to its employees, new branch opening, etc. The last element is tenor premium. It is not specified to a borrower. Instead, it is uniform for all type of loans. The tenure increases if the reset period is higher. With a longer duration of a loan, its risk increases. To cover this risk, the bank charges an amount from the borrowers. This amount is called the tenor premium. Hence, the components of MCLR are marginal cost of funds, negative carry on account of CRR, operating cost, and tenor premium. External benchmark based lending rate EBLR. To ensure complete transparency and standardization, RBI mandated the banks to adopt a uniform external benchmark within a loan category effective from 1st October 2019. Unlike MCLR, which was internal system for each bank, RBI has offered banks the options to choose from 4 external benchmarking mechanisms. These are the RBI repo rate, the 91-day T-bill yield, the 182-day T-bill yield, or any other benchmark interest rate as developed by Financial Benchmarks India Private Limited. All new floating rate personal or retail loans like housing loan, auto loans, and floating rate loans to micro and small enterprises extended by the banks from 1st October 2019 and medium enterprises from 1st April 2020 shall be benchmarked to one of the following: the RBI policy repo rate, Government of India 3-month Treasury bill yield published by the Financial Benchmark India Private Limited, or Government of India 6-month Treasury bill yield published by the FBIL, or any other benchmark interest rate published by the FBIL. Banks are free to offer such external benchmark linked loans to other types of borrowers as well. Some of the benefits of EBLR are Banks are free to decide the spread over the external benchmark. However, the interest rate must be reset as per the external benchmark at least once every 3 months. Being an external system, this means any policy rate cut decision will reach borrowers faster. The adoption of external benchmarking will make interest rates transparent. The borrowers will also know the spread or profit margin for each bank over the fixed interest rate, making loan comparisons easier and more transparent. Reset of interest rates under external benchmark is at least once in 3 months. Some other important guidelines: interest rate on loans. Actual lending rates will be MCLR or benchmark rate plus the component of spread. There will be no lending below the MCLR of a particular maturity for all loans linked to that benchmark. Spread under MCLR. The components of spread charged to a customer will include business strategy, including market competition, embedded options in the loan product, market liquidity of the loans, etc., and credit risk premium. Spread under the EBLR. Banks are free to decide the spread over the external benchmark. However, credit risk premium may undergo only change when borrower's credit assessment undergoes a substantial change as agreed upon it in the loan contract. Further, other components of spread, including operating cost, could be altered once in 3 years. Exemptions from MCLR and external benchmark rate. Following are the exemptions from MCLR and external benchmark rate. Specially formulated schemes by Government of India, wherein banks have to charge interest rates as per the scheme. Working capital term loan, funded interest term loan as part of the rectification or restructuring package. Loans granted under different refinance scheme by Government of India. Advance to bank's customer against their own deposits. Advance to bank's own employees including the retired employees. Advance granted to chief executive officer or whole-time directors, and loans linked to a determined external market benchmark, and fixed rate loans granted by the banks. So these are the loans which are exempted from MCLR and EBLR. Thank you so much for attending the class. We will see you in the next class.